Hello and welcome everyone to another Popular Investor interview. Today we have Patryk, who is slow and steady. Patryk, how did you become a trader and how did you find eToro?
First off, thank you for having me here, Henry. You can just call me Patryk. You do spell my name in a funny way, but just call me Patryk. That would be a lot easier.
Yeah, Patryk is a very, very, very common Irish name, so I'm well averse in calling someone Patryk.
Yeah. So how did I get into trading, or maybe specifically investing? Because I think I'm less of a trader, more of a medium-term investor. Henry, I started trading while I was still at university. I believe I was 19 or 20 when I opened my first few positions. And I was actually triggered by a number of finance courses that we had at that point in time. So I think that was in 2007, 2008. And I must say that I made a lot of textbook mistakes, which got amplified severely when the financial crisis hit in 2008 and 2009. So from that perspective, starting investing, trading in 2007 was a hell of a ride. I think
it's probably the equivalent of someone starting to trade now.
Or you mean in March 2020?
Yeah, so the sort of the equivalent of you starting to trade in 2017 is probably the equivalent of someone trying to start in March now, yeah?
Yes. On the upside, it's a hell of a school. You will immediately learn the mistakes. And if you're lucky, you're not invested too much up front. So I was still studying. I was a student. I didn't have much money left after I paid for my tuition, pizza and beers. So while it did impact my portfolio in percentage terms, in absolute terms, I didn't lose too much, and it was a hell of a school. And I think at that time, my main mistakes were that I was too concentrated in too few assets. And frankly speaking, I had zero hedge positions. So I was very happy to make those mistakes early on and try not to repeat them from that point onwards. I did retreat from the market in 2008 for a number of years. And when I graduated, I regained my courage and started to invest slow and steady again for the long run.
So you have now learned from the likes of 2007, you've come back, you're much stronger, you've now been trading for a lot of years, and you're now one of our popular investors. So why did you become a popular investor with eToro?
So eToro was mentioned to me by my colleagues while I was doing a technology project with them. I'm only a part-time investor and a full-time technology consultant. So we were doing actually an implementation for an international bank, and we were casually discussing the future threats of financial services, or of fintech for financial services. And naturally, one of my colleagues mentioned eToro. Out of curiosity, I set out to investigate it. And you know what? I think I quickly discovered that eToro and fintech can be named in one and the same sentence. It's just a great example of innovation within the industry, and I think you guys have done a hell of a job. So initially, I experimented with, I guess, the unique selling point of eToro, which is that you can copy others, right? And that is how I initially knew eToro. So I moved 2% of my wallet share from my previous broker into eToro, and I started copying out other investors with mixed results, I must say. But as I was copying other investors, as I started to get to know the platform better, I quickly discovered that there are some great advantages of eToro versus especially my previous broker. And one of those advantages was that the spreads that were offered with ETFs, as well as the fees, which at eToro are zero for unleveraged ETFs, could not be beaten by my previous broker. So at that point in time, I actually decided to shift a big part of my wallet share from my previous broker into eToro. And I started trading ETFs following that strategy I've been following for many years now.
So
Yeah. Go ahead.
So you trade a lot of ETFs. Now that is something that I've never traded. I know very, very little about ETFs. So a lot of people out there with the crash in the markets or crash. Look, people say crash. I like to call it a pullback. The correction in the market that we had in March. A lot of people have changed their strategies. Now, for someone who trades ETFs, have you changed your strategy, or has your strategy stayed the same through the pandemic?
It has stayed the same in the sense that I always have equity positions opened in exchange-traded funds of which I believe that they will outperform the market. And at the same time, I never take it for granted that they will go up. So throughout that entire period of volatility that we've had over the last couple of months, I was significantly hedged. And, for me, I see it as a prime responsibility to manage the risk around my assets. I've been working very hard to save up money and invest that, and I want my assets to work for me in the future. So I'm not necessarily trying to, optimize my return, but I see it primarily as my responsibility to manage the risk around it. So the great thing about that has been that my portfolio hasn't gone through that massive leg down. The downside was that while we had a massive leg up again, I did not benefit from it as much as many other investors did. That having said, it has been a slow and steady ride throughout that period of volatility. And I haven't had a single night that I didn't sleep well. I always knew that whatever is going to happen tomorrow, and there are plenty of crazy nights, that it would be fine, Yeah.
Whereas you have sat through all that, whereas me as a trader who trades the likes of currencies and stocks, I actually closed all my positions because I was expecting the market to correct and pull back anyway normally. And generally when you have an overextension like that, the correction is about 30%. So personally, I closed all my trades, but you were still exposed. Your trades just carried on throughout that.
No, so I wasn't exposed through the entire leg down. Just like you, at the end of February, having read everything I could about COVID and having been through this bull cycle of 11 years, I thought that the market was streaming for some type of reverse, some type of correction. Yeah. So at that point in time, I thought,
that's a good word.
Yeah, there was just very little upside potential to this. Whereas the downside potential is huge. And, we haven't had a black swan event for a number of years now. So I did retreat for 2 or 3 weeks, 2.5 weeks, and then jumped in at the end of March while things were still very uncertain, and slowly but steadily started building up my positions again. Equity, mostly at that point in time, NASDAQ, healthcare, and consumer staples, but always heavily hedged with United States government bonds and to some extent gold.
Okay. So you said a black swan event. What is that? Because a lot of our users would have never actually heard that before.
So, it is to be expected that once every 4 years we have a U.S. presidential election, and that might impact the markets, right? It is an event that happens every 4 years. So that's on the one hand of the spectrum. On the other hand of the spectrum are events that are unique, like a black swan, and they are not accounted for. People do not know what will happen when they actually occur. So COVID-19, to some extent, was a black swan event that was predicted by some smart people like Bill Gates, who said that the biggest threat that we have right now out there is a possible contagion. Yep.
So you at the present moment have 2,000 users copying you. So there's a lot of people who have put a lot of trust into you. So what would you say to new users who are new copiers who want to come in and actually follow your strategy? how would you gain their trust and get them to put money with you?
Yeah. So first off, maybe more of a generic statement about any popular investor that has reached the elite status. So eToro requires from every single one of us that we have significant skin in the game. And I think maybe early on that was a bit different. But today, if you are an elite popular investor, eToro requires that we have at least 25,000 US dollars with eToro. So I have a significant part of my wallet invested in eToro, as well as into this strategy that I'm following on a monthly basis. Now, I manage my assets with great care, simply because I've been saving up that money, and I want that money eventually to start working for me so that I can retire early. But abstracting from that and that skin in the game level that every elite popular investor needs to have, I think I would encourage my followers, maybe future copiers, to just take a look at my stats. And one of the things that you will see there is that I have consistently had a risk score on average of not more than 3. So despite the fact that the last months were very volatile, right? Despite the fact that there were so many opportunities out there, I wasn't chasing the opportunities. I was always consistently focusing on managing the risk, because, we all know today that it has gone up, but there were plenty of moments where I thought, is it still going to go up the next day? So at any given point in time, I'm always focusing on managing that risk. And I think in addition to that, there's something that I posted in my last post, since eToro created new stats that we can expose as popular investors. I shared with my followers a dashboard in which eToro had analyzed my Sharpe ratio over the last couple of months. And that Sharpe ratio came at 1.97, I believe. So for those of you on the call that do not know what a Sharpe ratio is, it measures how many units of return one can expect for every unit of risk taken. So a Sharpe ratio of 1.97 means essentially that for every 1 unit of risk that I took over the last couple of months, I have returned 1.97 units of profit. And I think, in the industry, that is considered a very good ratio. Yes, I may not have the highest return out there from all the popular investors, but I do have a very low risk score. And given that low risk score, given the risk that I took, I've managed to squeeze out a very decent return. Yeah.
It's like something my nan always said: look after the pounds and the pennies, or look after the pennies and the pounds look after themselves. So yeah, the risk, keeping the risk low, that is a fundamental of anyone who's trading. That is something on the eToro trading school that I drum into people. It's, to me, it's the basis of every winning trade, is keeping your risk score level are low. But yeah, to me, that's the basics. Now, you have a lot of people who are following you. So I have people who have wanted to become popular investors. I've spoken to them about it, and then all of a sudden they're about to put their toe in the market, and then they think about they're actually trading other people's money. So they sometimes get scared, they get nervous, they worry about stuff. What happens if I have a losing trade? Is that something that affects you?
In the very first 2 weeks, where my number of copiers exploded, it was a bit of a reality check. Like, whoa, there's a lot of people putting trust in you right now. But I quickly actually started standing again with 2 feet on the ground. And while that explosion of the number of copiers happened, I haven't changed my strategy at all. I continue to analyze the best type of equity positions or equity ETFs that I can find. I continue to always hedge those equity positions. And I think on the long run, this is my path towards early retirement. I aim to always have a solid return given the risk that I take, but never less than 7% per year. There will be bad years, but I think, looking at the strategy so far, looking at how the said strategy has performed in the past, I'm confident that we will come out on top. And I think on top of that, every strategy has what I call start date sensitivity. And every single investor, or if you're about to copy someone on eToro, you're going to be subject to that. So what is start date sensitivity? It's, like every popular investor out there, every strategy will have drawdowns, right? So my drawdown, yep. I think the highest daily drawdown that I've had was 1.5%. Highest weekly drawdown was 2.7%. And the highest drawdown I had within a period of 12 months was minus 3.5%. That's trading, that's investing. It's part of it. If you happen to copy someone or start trading in 2007, you're going to have that massive drawdown. And the paradox is, for example, if you started copying me yesterday, you will have also experienced a drawdown of minus 1.4% because my strategy resulted in a loss of minus 1.4% yesterday. But on the long run, every strategy, every popular investor out there that has a lot of copiers, they have given solid returns to all of their copiers. And I think you should just accept the fact that drawdowns will happen. So you need to figure out for yourself what type of drawdown you're willing to accept. And before you actually hit copy on any trader out there, take a look at his risk score, his risk stats, and the drawdown that they have had in the past. And if it says that the highest daily drawdown was minus 4%, then don't get scared when your portfolio drops 4%. It will go up on the long run. And if there is any advice that I can give to future copiers or people that are thinking of starting to copy others on eToro, is that there's two strategies of going around that drawdown, that start date sensitivity. And that is that at any given point in time, when you decide to invest on eToro and you prefer to copy others rather than invest yourself, pick 2, 3, 4, 5, 6, up to 10 different popular investors and copy them more or less at the same time. Because, what's the chance that all 10 of them will have a bad day? However, if you just copy one guy or one lady, then there's a likelihood or a higher likelihood that you will copy him on that day where his portfolio is subject to that bigger drawdown. Another strategy of addressing that start date sensitivity dilemma is if you want to invest, I don't know, $1,000 into a copier that you like, split it over a period of 5 months. $200 in month 1, $200 in month 2, 3, 4, and 5. And with that approach, you limit the risk of copying a copier with $1,000 and him or his portfolio being subject to a daily drawdown of 1.5% the next day, for example.
Yeah, so you're equivalently dollar cost averaging in with the money that you want to start following someone.
Correct. So dollar cost average the money that you have allocated to a copier, or diversify, right? Copy 4, 5, 6, 7 good popular investors who have slightly different asset classes. We have popular investors who are really great in trading foreign currency. I'm one of those popular investors that limits himself to ETFs. And there's plenty of popular investors that are investing in name stocks like Apple, Microsoft, and the usual suspects.
Now, what books do you read or investors that inspired you, and where do you see yourself going in the future?
To answer the first question, I've read a number of books in the space of financial money management, but there's actually 2 books that I got from my bookshelf that I would recommend to everybody to read. And the first one is The Little Book of Common Sense Investing, that was written by John C. Bogle. He's actually the founder of the Vanguard Group, which pioneered ETF instruments. And then the other book is The Intelligent Investor by Benjamin Graham. Now, the cool thing is that when you read both of these books, you will naturally feel more comfort towards one or the other. And by reading one of these books, you will know whether you are a value investor, which is what the Intelligent Investor book focuses on. It focuses on value investing, or whether you're more of a indexed and ETF investor, which is the premise of the common sense of investing. So naturally, because I invest mostly in ETFs, I like this book more. On the upside, it's also a bit thinner. So if you have some days spare, you should definitely take a look at it. I would recommend starting with this one and moving on to The Intelligent Investor. So that having said, 80% of my assets is in ETFs. I do trade named stocks, but not as part of the slow and steady portfolio. It's because this is where I feel most comfortable with. And it's definitely something that I can recommend to every investor out there to consider exchange traded funds. And, I think the mere fact that my account manager called me a number of months ago and suggested that I enlist to become a popular investor because of my strategy and the performance that I've shown throughout shows that ETF investing is a viable strategy for some.
It's not as sexy as stocks or FX, but as you've shown over the last couple of months or year, that it is something that is highly profitable and can be used as well.
Yeah, I definitely agree that it's not as sexy.
Now, one of the questions from our audience there is: do you use any kind of automation for trading, like essentially bots? Or is it all you have to pull the trigger yourself?
No, I don't use any automation, but I have built up a certain cadence in order to prevent timing the market. One of the things that I've learned from reading a number of books is that, timing the market is very difficult, and what is more important is time in the market rather than timing the market. So rather than timing the market and using bots, I have a monthly cadence, and at the end of every month, effective at the beginning of every month, I review my portfolio and I make adjustments as needed. That does not mean, though, that everything is the creation of my own mind. I have a structured approach. I think I can very briefly elaborate on that. I use trend momentum of ETFs to make a short list of ETFs that have had great momentum over the last couple of months. And research has shown that momentum trades or past momentum trades are a good predictor of future momentum. So that returns a nice short list of ETFs that have been doing well in the past, in the last 3 to 6 months. I subsequently continue with vetting that short list, right? So we have a short list of quality ETFs that have been doing great. But for each of these short lists, I try to assess future risk, political risk, economic risk, and so on. And that list essentially becomes even smaller. Last but not least, I conduct a correlation analysis between the short list of the short list in order to filter out ETFs that are highly correlated to each other. Because why invest in 2 ETFs that go up in tandem and go down in tandem if you can just invest in either one of those? And the final thing that I do before I actually decide my allocations, meaning how much percentage goes into what ETFs, is a risk parity analysis. And that type of analysis it identifies the inherent risk with every ETF that you have selected and tries to balance out the risk across the ETFs that you want to invest in. So, for example, if the S&P 500 has been very volatile, in other words, very risky, and bonds have been less volatile over a period of time, then such analysis will tell you, well, maybe you should invest 66% of your assets in bonds and 33% of your assets in the S&P 500 so that you even out the risk associated with either one of those. And if there's one tool that I can recommend to everybody that I've been using heavily, it's an online service which is called portfoliovisualizer.com. It contains historical data of a lot of ETFs, but increasingly also named stocks. And it will allow you to perform that correlation analysis, and it will allow you to perform that risk parity analysis to, return a portfolio that is less risky.
Thank you very much. So, what do you think of gold after what has just happened? Because it's been on a record high. It's just been going on. It's like one of these trains that has just continued to go, and then it just hit a dead end. So would you expect it to retrace, or do you expect it to continue?
So I opened my main gold position 4.5 months ago, although it may look differently right now in my portfolio because I did a rebalancing, but basically I had gold in July and I still have gold in August. And I've made a solid return on investment with gold. Now, what we've seen yesterday, that drop of -5-6%, that's the highest drop that we've seen in the last 7 years on gold. One might say maybe even a black swan type of event. It doesn't happen very often, once every 7 years. It's pretty extraordinary. That having said, the reason why gold has been going up is, among others, how much money has been printed by central banks. So while yesterday, and I think this is my personal opinion, while Russia announced that they have a vaccine, right? And while the United States government has not yet agreed on further stimulus, so they're not yet heavily continuing printing money, the fundamentals of why gold has gone up in the last couple of months have not changed. We're sitting on a massive pile of debt. Someone is going to have to pay that debt back, or we're going to have to erase that debt with inflation. So yes, we've had a massive drop yesterday. It may go down even further, but on the long run, I still think that gold will appreciate in value. Don't ask me about the short term because I don't know what's going to happen tomorrow. Not clever enough for that. And that is the reason why I always hedge my position. So I'm not just only in gold, I'm also in equity, making sure that I catch a percentage of every trade.
So you don't have a direct line to God. He doesn't tell you what's going to happen with gold tomorrow, no?
Unfortunately not, no.
Now, one of probably the last question that we'll have time for from the audience is, if you weren't a popular investor, would you trade the same way, or would you take more riskier trades? Would you invest differently? Would you put more money onto a particular trade? Would you trade some ETFs and some stocks? Would you be trading differently if you weren't a popular investor?
Yeah, so if you listened carefully, I said throughout this interview that I have a wallet share percentage in eToro. At the same time, I always like to manage my risk, split my risk. So I do also have another broker, but also on eToro, I have a second account. And I do trade, or sorry, I don't trade. I invest in named stocks, mostly in cloud technology companies, simply because I work in that industry and I have a solid understanding of the business model. So if you're willing to invest time, or if you already understand business models in a certain industry and you're able to gauge the performance and the future performance of companies, of publicly listed companies, then hell yeah, you should allocate some money to named stocks, right? Like Apple or Microsoft. There's a number of usual suspects over there. I don't want to go into details, but you do need to find the right split. In my case, call me a chicken, I like my risk-averse strategy that is reflected by slow and steady, and 80% of my assets follow that strategy, where I spread my risks as much as possible using the unique characteristics that ETFs give you. And 20% of my assets is in named stocks, where I try to take or get an edge and increase my return on investment. But I'm not the type of guy that has the courage, let's say, to go 100% on stocks. On top of that, I also always remain invested in bonds because I want to hedge against the risk of stocks going down. So yes, you should, but you need to figure out for yourself that the level of comfort you're comfortable with in terms of whether it's going to be 10% stocks, 90% ETFs, or maybe the other way around, 10% ETFs, 90% stocks.
Well, Patrick, I definitely won't call you a chicken because your results there speak for themselves. Now, that's about all we have time for. So where will our new copiers and new investors, where will they find you, or how can they find you? Or is there anything else you do? Do you have a blog? Is it on the feed? Is there anything else that you do?
No, today I limit my my social exposure only to eToro. So you can find me under my nickname, which is slow_and_steady, slow and steady. And that pretty much also resembles the strategy that I follow. I do post on a monthly basis. I review my portfolio. I always provide insights on what I expect to happen next. I will be increasing that frequency to maybe a weekly or on a bi-weekly basis, but at a minimum, you can expect me to reach out to all of my copiers on a monthly basis.
Well, thank you very much, Patrick. It's been very, very insightful. It's something that I know very, very little about is ETFs, and I now feel that I've learned a little bit today. So thank you very much for that. Also, anyone who wants to join me on my trading school or want to enroll in any of the courses, they're all free. You can go to the eToro Trading School or click on the link there with the course link. We also have a podcast, which we actually do every Tuesday. So it's up online in between Wednesday and Thursday. So make sure everyone else has done that, so you can actually jump in on board with that. And thank you very much. It's been an absolute pleasure, and I hope you guys have a lovely day. And thank you very much, everyone, for joining in on us.
Thank you, Henry. Take care, guys.
You're welcome. Bye bye.